Hey guys, V. Rigoni, Max, high performance real estate entrepreneur. So this is the second part of a 3-part series that we'll be talking about. How do we get to the first rental property, right? How do we buy that first rental property? I get it. We're going to be talking about mindset, everything else, but this is about the nuts and bolts. What do you actually have to do? In the first one, we talked about the credit, right? Where's your credit score? How do you get your, where's that now? How you got it there? Well, nobody cares. How are you going to get it up? That's what all matters, right? And so that's what we talked about in that first part of the series. Now, today, what we're talking about is the mortgage, right? We're going to talk about the mortgage, baby. Why? Because the mortgage is where it's at. There, I get it. We'll get there again. We'll talk about that owner financing. But right now, we're talking about how to get to the mortgage, right? Now, as the mortgage, there's also the down payment. So they kind of go hand in hand, don't they? Right? Do you need a down payment? Right? Absolutely. Can you buy something with zero down? Yeah, I get it. There's ways to do it, but that's not what we're talking about here. We're not looking at the outliers. Where is it that the average person that wants to get into real estate can start investing? They don't even own a home yet. They own no real estate. That's the average person out there. They're renting. They've been doing it for years. Now, how do you get into this thing called, I want to own rental income. I want to start to create some rental properties to get that rental income and to do what I need to do. And so that's where we're at. And so then let's talk about the number one route in which to do that. Where do most people who don't have a lot of down payment, because I'm assuming you don't have a lot of a down payment, right? I mean, and if you do, well, then you're still going to want to go this route anyways, because you're going to want to keep as much liquidity as possible, keep as much cash, because you go forward, you get to scale, right? Right? Think big, start small, grow fast. Use the extra liquidity for scaling. And so that comes in the form of getting your first mortgage and then getting borrow the most you can. Why do you want to borrow the most amount of money on real estate you can? Because you get to pay off the loan with inflated dollars. Yes, it costs you less in real money because the dollar inflates and then you get due to inflation, and then you pay it off with inflated dollars. That's right. Why? Because your salary goes up and your property values go up and your rents go up. And then you get to use those dollars to pay off a stagnant fixed loan. That's right. So that's kind of the concept around the whole idea of borrowing money on real estate, And so when you're looking at a loan, you got your conventional loans, you got your government loans. And the conventional loans, yes, you can get a mortgage with 5% down, you get one with 10% down, you get one with 20% down. I get it. But they have other restrictions. They have different loan to values. They have different or income ratios. They have all these different things and nuances. The easiest loan to get if you're going to be your first property. And remember, your first property is that even though you may live in it, is going to become your first what? Your first rental. Because I'm not here just talking about how to buy a house to live in for the rest of your life. You could talk to your mom and dad about that. Because chances are they only own one, and it's that one, and they've been paying it for God's sake how long? And if you're not 30 yet, they're still paying it. No, we're not going down that route. We're going down the route that this is going to be your first rental property. And so you're going to want to put the least amount of money down. And the way to do that is you go with a government-backed loan, a government-insured loan. The government is not giving you the money. They're insuring a percentage of the loan to the lender that you're borrowing the money from. FHA, right? Federal Housing Authority. That's who you're borrowing. You're borrowing the money from Chase, or you're borrowing the money from Citibank, or you're borrowing the money from a private mortgage company. But FHA is backing the loan. They're backing the insurance on the loan. And so that's where we're going here. Now, what are their requirements, right? Do I care about what's going on in the conventional side? Well, yeah, but this conversation is about how to buy your first house with the least amount of money down, with the lowest, maybe some more challenging credit score. Right? And so that would be FHA. Now, again, when I say FHA, you don't go to FHA and buy a house. They don't write the mortgage. You go to a lender who then that has to follow FHA guidelines. And if they follow the guidelines, then they get the FHA insurance on the loan. You pay for that, by the way, but this is what you do. So their minimum requirement for a down payment is 3.5%. That's right, 3.5%. That's like $7,000 on a $200,000 house. Hell, you may have put more money down on a car that you recently bought. So we're not talking about a whole lot of money. We're talking about a $200,000 house. You're going to be putting down $7,000, 3.5%. Now, yes, you do have to be able to get those dollars, right? So you have to be able to do that. But we'll talk about that in a minute. So when you go FHA, you can borrow for a single family home, you can borrow up to 4 units. So you can buy a house for a rental property that is a single family house or a 4 unit. Now, when you're talking to them, they're not, unless it's a multi-unit building, a 2 or 3, they don't want to hear rental property. You're buying, if it's a single family, they want to hear that it's going to be your house, right? Because there's a requirement when you go to buy that house. You got to live in it for at least 1 year. You just can't go buy it and say, hey, yeah, I'm going to get this loan, guys. Can you write me up this loan? You go to Chase. I'm using it for a rental. Tenants are moving in tomorrow. Well, they're not going to give you the loan. And I'm not telling you to lie on a loan application. What I'm telling you to do is move in it for the first year. Yeah, is it possible to hack some of the rooms? I would think so. I'm sure it's kind of a gray area, but it's probably an acceptable gray area. No one says you can't have roommates. And no one says those roommates can't pay you some money to stay there, right? So if you're single, or even if you're newly married, you could do some house hacking, as they call it, right? But you're going to need 3.5% down. Chances are you're buying anything between a 1-unit single family or up to a 4-unit multifamily. And we'll talk about the multifamily and as we go along. So then, what kind of credit score do you got to have, right? Because we talked about credit score in the first program of the series. Well, the bottom line is, if you want to put 3.5% down, you got to have a 580 credit score at a minimum. That's what the guideline is. That is what the FHA guideline is. Now, that also means that the lower your credit score, chances are you're going to pay a little bit more interest, okay? Because you get breaks as the higher your credit score goes. At certain points, they give you little breaks in the interest rate. Okay, they have some room to work with it. Now, they'll lend you at a 500 credit score if you're willing to put 10% down, FHA. That's right, 10% down. They'll give you a credit score. You can go in with a credit score of 500. Well, that's insane, right? Now, here's the problem. You got to find a lender. These are the minimum FHA guidelines, but that doesn't mean that the lender has to agree to do that. They could demand a higher credit score. They could say, well, we don't give out FHA. We don't do the FHA program unless people have at least a 600. The average is 620 is what they're looking for, a 620 credit score. So if you got a 620 credit score and you can put 3.5% down, then you can be moving forward on an FHA loan. Now, is the down payment the only thing that they're dealing with? No, because we just talked about the credit score, right? But they want your credit report. They want to make sure that you're making your payments on time, all that kind of stuff, right? That's what the credit score says. And as long as it's at the numbers in which they're willing to accept. Now, if you're going to a place and you don't have a 620 credit score and yours is 580, then you may have to do a little bit more research. You may have to make some more phone calls, pound the phone, and find a bank, a brokerage company that will lend at the minimum requirement by the FHA. I guarantee they're out there. Now, you're probably going to have to pay a little bit higher interest rate, like I said, but don't let stuff stop you. Don't let this crap stop you. Find the solution. And in this case, it might be making 50 phone calls. It might be making 10 phone calls. My question is, how badly do you want it? So while you're doing this, you can also be repairing your credit score, right? And there are actually mortgage brokers out there that will literally help you repair your credit score. They'll put you into a program because they want your future loan. So if it's, really low right now, okay, and you can actually literally find mortgage brokers out there that will help you redo the repair and get you to the minimum so then they can get the loan, they get the commission, yes, but look at what they've done for you. So go look for one of those lenders. Don't let things stop you. That is the thing. Even in our first program here, I talked about credit, but don't let the credit stop you. Find a solution. Go over the mountain, go around the mountain, go through the mountain, but get to the other side of the damn mountain. That's really the bottom line. So you got this minimum of 500, 10% down. We know that lenders, they're going to require mostly around 6 to 620. Now, again, you might pay a little bit more interest, no problem, but you still got to the other side of the mountain, didn't you? Now, there's another thing called, your debt to income ratio. So they look at your overall debt. What does your credit score, credit report show? Right? Because they don't just look at the score, they also pull up your credit report. And then they look at that and they say, how much does this person have in outstanding credit? Your car loan, your furniture loans, all these traps that they do, they get you into buying shit you shouldn't be buying. Don't be going out and buying furniture on credit. It's ridiculous, especially as a renter, because that debt is going to be on there. And if you decide to go start buying some rental properties to get your first house to live in, whatever you're talking about here, that's going to be part of the debt they're going to take into consideration that will reduce the amount of money they're willing to lend you. So don't let stupid debt get in the way of important debt. Remember, credit card debt sucks unless you're using it to fix up a rental property. Car debt sucks unless you're not paying, unless you get the right to hold thing off and you bought the truck and you don't have to pay taxes on it either. There's some reasons that some adjustments. Of debt that is not for business purposes is bad debt. We're talking about here is good debt, is a mortgage debt. Maybe we should have started out by saying a mortgage is good debt. Why? Because of all the things that real estate will do for you, right? Rents, right? Positive cash flow, rents going up, appreciation. In other words, the property goes up, leverage. In other words, the appreciation's on the price of the home, not on the 3.5% down payment. So if the house goes up, if it's a $200,000 house and it went up $10,000 and you put 3.5% down, how did you do on a cash-on-cash basis? What was your return? Off the freaking charts. So there's real estate debt is good debt. Mortgage debt can be very good debt. Can you screw your life up and get the wrong kind of mortgage on a property? Absolutely. We're seeing that today. We'll talk about it in a different podcast. But what we're talking about here is buying that first rental property. You're going to use it as your home for the first year because the requirement is to stay in it for 1 year. Now, when it comes to this credit, how much they'll lend you, it's no more than 43% that they'll lend you based upon overall debt to income. So if your mortgage is going to be $1,200 and you owe another $1,000 a month in payments, that whole debt on a monthly basis, that $2,200 cannot make up more than 43% of your income. Does that make sense? So you can see that the lower you have in other debt, the more mortgage you can get. As far as I'm concerned, credit cards, credit card scores, all this stuff around credit, it's only there so that you can go out and buy the property and get the right kind of mortgage and buy the biggest one you can for the purposes of rental, and that's what it's for. All this other consumer debt, ridiculous, stupid, it's a trap, just going to take your money. You go buy that, for the average person, they go use a credit card at McDonald's. Like I say, they're going to be paying off that stinking hamburger for the next 15 or 20 years. Why? Because they make the minimum payments on their credit card. Don't be a fool. Don't be stupid. Back in the day, I don't know how many times when back in the 60s, you grew up, you heard two things: shut up and quit being stupid. When I get it, you guys don't hear that stuff anymore, but sometimes you got to hear it. Sometimes you do got to hear it. And so in this case, keep that consumer debt down because there's a debt to income ratio, and it can't be 60%. Why? Because they know you have other expenses. You got to pay the car insurance. You got to pay the electric bill, the heat bill, the repairs, all that. Right? All that other has to add up, that other 57% that you got to have in order to pay all your other bills. And how did they come up with this number? Well, because of experience. time. Now they've expanded it a little bit by about 3% from what it used to be. And because, they understand that people need a certain amount of money historically. The evidence, right? The statistics show that if 50% of your money is in debt for real estate or any other kind of debt, you're going to struggle in the rest of your life. Now you might say, yeah, but I'm willing to struggle because I'm all in. I'm going to buy rental properties. Yes, I get it. But they're going based upon the average person. And when you're buying your first rental property that's a single family, they don't want to hear the word rental, right? I already talked about that. All right. You're moving in. You're staying in. But remember, you got to be there for at least 1 year. Okay? Now, you can't have more than 31% of the debt as part of the mortgage. So they know that you're going to have, most people will have a car payment. So it's 43% overall, and not more than 31% of your income can go towards a mortgage payment. Now, I remember back in the day, okay, it couldn't, at one point, it was not more than 25% that you could go towards a mortgage payment. Now they've expanded that out to 31%. Now, so that you can't do it. It's just not going to give you the mortgage, all right? Now, conventional, they have different rules. That number might be higher, but because they don't have to follow FHA guidelines. See, all of this is about following the FHA guidelines. So that why? So you could put down 3.5%, and you can have up to 43% of debt, including your mortgage, against your income, okay, on a monthly basis. Because typically conventional loans will not allow you to go that high. So then there's that. Now there's another thing that you got to understand on these loans is that it's closing costs, right? And they usually are a couple percentage of, 1%, 1.5%. There's different costs that come into closing costs, including a thing called MIP, mortgage insurance premium. Because again, the government is insuring these loans, and so they want to make sure that some cost of that is going to be offset by a pool of insurance premiums that come in, right? Because what is insurance for? It's because they know there's going to be a certain amount of accidents if it's an auto, car, or a certain amount of fires if it's a house. They also know there's going to be a certain amount of foreclosures on these loans. A certain amount of people won't pay, and so then they're pooling the insurance from everybody to cover the ones that don't pay. So the government doesn't have to foot the bill, okay? Because they insure a great amount of your loan to the bank. All right? And so it's called MIP, mortgage insurance premium. You got to pay that in. Now, that could be anywhere from 15 basis points to 75 basis points onto your loan every year. Every year. So basically, you might say, well, what's a basis point? Well, let's get in the real world here. We're talking real estate. A basis point is 1/100 of 1%. So 1/4% is 25 basis points, right? So we're going from 15 basis points to 0.75% or 75 basis points. All right, and so that's added to your loan. Now, that could be, you have to pay some of this premium at the closing, and then you have other closing costs in there, right? Now, FHA guidelines allows, obviously, for you to pay it, okay? But they also allow for the seller to pay some of these fees and some of the different fees that go along with an FHA loan, so that you can have negotiated into your contract that the seller will pay the fees. Is the seller going to take less money? No. They may want you to increase the price to cover it. But again, you don't have it in cash. Someone's got to pay it. So increase the price in order to cover it. Now, the house still has to appraise out. What we mean by that is when they go to do the valuation on the property, that anything that's, whether it's the purchase price or any fees that the seller is going to pay, the value of the property has to show that it can handle both the purchase price and the fees that the seller is going to pay for the buyer. But there are times that we're going into one of those periods of times, I do believe at some point here, that we're going to go into a period of time where sellers are willing to pay some of these fees. Now, if it's really bad economic times and the sellers are really in trouble, you're not adjusting the price for the fees. It's just part of the deal. But right now, because of where the pricing of homes are, if you're going to use an FHA loan, chances are you've got to adjust your offer to allow for that. But again, you're getting in then for just 3.5% down, because most of your fees are going to be paid by the seller's contribution. And the FHA guidelines allow for that. So therefore the bank allows for that. Really important. So that's a big one. Another one is taxes and insurance escrows. Right? So you got taxes and insurance on this property, right? And in the world of mortgages, it's called PITI. Principal, your payment is made up of principal, interest, taxes, and insurance every single month. The TI in this is taxes and insurance. So the taxes are pretty much adjusted from the fact that they're going to be an escrow set up because the taxes are paid in the arrears in most locations. But you're going to have to add to your mortgage payment 1/12, okay, of the amount of the future tax bill to that. And then that money is held in an escrow account. And so that your mortgage company will hold that. Same thing for the homeowner's insurance. You're going to have to go out and buy a 1-year prepaid homeowner's policy for your house, the one you're buying, the property you're buying. And then after that, 1/12 of that will be held in an escrow. So you included in your next payment will be the principal, the interest payment on the loan, the taxes at the tax escrow, 1/12 of the future tax bill, and then 1/12 of the insurance. All right. Now, from time to time, these escrows get adjusted. You'll get a thing in the mail from the bank saying that, hey, we see that the insurance, we got the new bill, the insurance premium's going up, so we have to adjust your insurance escrow. Same thing with taxes. Now, one thing, understand, it's your property. It's the bank. You owe the bank money. But if the bank doesn't make the payment, it's on you. So when the bill comes due to make for the bill on the insurance to be paid, and you're saying, well, the money's in the escrow, make sure you confirm that the bill got paid. Same thing when the tax bill. Sure, the bank is supposed to send the check and pay the tax bill. That's a given. But confirm it. Call the county. Say, hey, were my taxes paid? Look online. See if your taxes were paid. Because it's on you at the end. So don't let things like that fall through the cracks. Just make it part of your normal procedure. You're going to make a follow-up phone call once a year. Okay, you're going to check the website on your insurance for your insurance company. You're going to check the website for the county tax records. No big deal. Just do it. If you don't complain when they didn't pay it. And now you got to pay penalties or something worse. They sell your taxes. You just don't know. They've got millions of loans, right? You got one. So you think you should be concerned about your one, or just hope that they did everything on all the million loans that they've got? That's my point. And so that's where we're at. If you follow these. Now, there's one other thing here that we got to talk about when it comes to an FHA loan, and that is the appraisal. An FHA loan appraisal is different from a conventional loan appraisal. So they go out and they hire a company, the bank does, but the bank then hires an appraisal firm. The firm has to go out and appraise the property. So they're concerned about the price, right? Is that the only thing they're concerned about? Well, typically with a conventional loan, pretty much. There could be some things they got to worry about, but for the most part, pretty much. But on an FHA loan, and this is why sellers will sometimes give you a harder time about you wanting to buy their property and using an FHA loan, is because of the appraisal. Because the home has to meet certain guidelines. Because if they're going to insure the loan, they got to make sure that if they foreclose on the house, that they're not going to be dealing with problems that they weren't expecting. What are some of the ones? Well, one that comes to my mind that I dealt with a lot back years ago, especially in the area I was at, there was a lot of cottages that were being converted to single-family homes, year-round homes, I should say, and that was earth-to-wood contact. So if there is siding, wood siding that's going into the dirt, and how does that happen? Well, sometimes people build up the dirt so the water moves away from the building. So then they will go over the siding. Can you imagine? I can't believe it, but they do. That's not allowed. You got to have no earth to wood. That means that back in the day in a lot of these cottages, they didn't always have regular foundations. Sometimes they just had like cut off pieces of telephone post that was literally the foundation for the property. But whatever the earth to wood contact is, it has to be remediated. It has to be dealt with. All right, we've done it in the past, not a big deal, but you've got to know this. They're also going to look at, when it comes to the property, that the kitchen has the proper GFIs, the ground fault for the electric. So it's a little push button, you guys, that you see there in the kitchen and in the bathroom. They want to make sure that those are all put in. Typically they'll wire them together. If one goes off, they all go off so that you don't get yourself electrocuted. So those are the two big ones. It could be they want to make sure that the structure has a certain level of, integrity. Right. Well, you want to buy the right property anyways, because the last thing you want to do is buy a structure that doesn't have the right integrity. Because the last thing you make money on is fixing something that shouldn't be a problem. And what I mean by that is that if there's broken beams, this and that, yeah, they got to be fixed. You got to spend the money, but it didn't improve the value of the property. It may keep it from falling down, one could argue, but it doesn't make the value go up because it's supposed to not have. It's already not supposed to have a broken beam or a broken joist or whatever. They'll want to make sure the electrical box has breakers and that it's at least a 200 amp service. These are kind of things they're looking at. Some of the basics, I get it, but the appraisal has to not only conform, has to show a certain price, but it also then the property has to conform to some basic guidelines. Not difficult, most day and age, most neighborhoods, most suburbs, you're not going to have a problem. Some of the outlying areas, some of the recreational areas, like I said, where there's cottages, things of that nature, you could have a little more issue. So, another thing you might come to face is floodplain insurance. Okay? Is your property considered to be in a floodplain? You could be far away from a body of water and still be in a floodplain. It's just the way this thing works. So, they'll do a certificate. They're going to go and see. Every property has to have a certificate to show that it's not in the floodplain. So these are things that you're going to look at when you go for an FHA loan. So that's the whole concept around this kind of a mortgage. Now, let's just spend a minute and talk about if we're talking about getting a duplex or a threeplex or a 4-unit. I mean, how fantastic is that? You want to make sure that, can you do that? All right, now, in order to do that, they allow you to borrow more money for that purpose. On a single family, you can go up to about $478,000. $472 is the number, and then it can be expanded based upon where you're at. The maximum amount of money you can borrow from FHA for a single family, it could be $470,000 to $1,089,000. You might say, how can I get an FHA loan for $1,089,000? That's ridiculous. That would be like a rich house in my neighborhood. Yeah, but go to San Diego, and it's a 3-bedroom tri-level. That's just the reality. So the amount that they let you borrow is based upon the location in which you're in. Same thing with the multifamily. If you're in a multifamily, you're going to be able to, borrow more money for that purpose. Now, again, with multifamily, they'll let you, one of the big things is that they'll let you use up to 75% of the rent that is coming in on the units that are rented towards qualifying for your mortgage. That's right. You can use up to 75% of the rent. So if there's 3 units that are rented and you're going to move into the 4th unit because it's a 4-unit building, you get to use 75% of the rent of those 3 units. And that rent goes to help you qualify for the mortgage. That's fantastic. That's insane, right? So when we're talking about getting into the rental properties, if you've got duplexes in your area, if you've got 3 units and 4-unit buildings, then don't be looking for that single family house.